I'm Stu Glickman, Director of Fundamental Research for CFRA. Today is Monday, April 6th, and I just wanted to reach out briefly to talk about a sector downgrade that occurred last week. Our Chief Investment Strategist, Sam Stovall, downgraded our opinion on the energy sector to underweight from market weight. And I just wanted to run through a couple of the factors that led to that decision. Number one, Strait of Hormuz remains largely closed off. If you look back at, let's say, the last 12 months before the onset of war on February 28th, the Strait was averaging somewhere in the neighborhood of about 70 to 75 tankers per day transiting the Strait, moving crude oil and refined products from A to B. That level of tanker traffic is far, far lower today. In the last week or so, we're seeing perhaps a couple of tankers a day, not more than that. So even though we're a month into the conflict, it remains largely choked off. A very, very important flashpoint. Why is it so important? Because about 15 million barrels a day of crude oil and maybe between 5 and 6 million barrels a day of refined products normally transit the Strait. That's around 15% of global crude oil supply that normally makes its way out of there. It is not getting to market. It's already being felt in Asia, and we simply don't have the spare capacity in other places around the world to make up for it. Second point, as crude prices have risen, so too runs the risk that the macro economy is going to get choked off by high oil prices. If you look at prices at the pump, gasoline prices are north of $4 per gallon. Diesel prices are even higher. If this persists or gets even more acute in terms of the shortage, I think we can look forward to, unfortunately, even higher prices at the pump. And at some point, if this doesn't resolve itself shortly, we do think it has the potential for adverse impact to the global economy. That is not good for oil prices eventually. So we may end up with what looks like a sugar high. You have a spike in 2026 and a dramatic collapse in 2027. That's our concern. And then lastly, on a technical basis, Lowry Technical Research thinks that the energy sector remains overbought, stretched, or whatever you want to call it. Not the best time to get into this sector. It's run up considerably up over 30% year to date, and on a forward basis, trading well above historical forward averages. Thanks for your attention today. For more information on energy or any of the other 11 GICS sectors that we cover in our STARS universe, please visit us at www.marketscope.com.